One of the most important things you have to know when you're trading options is the implied volatility and how that'll affect your trade. In this video, I'm going to talk about that. So, a lot of people don't know the risk behind options because they think when the stock goes up, your trade is going to go up. When the stock goes down, your trade is going to go down, assuming you're in calls, for example. But there's obviously a lot more factors when you're trading options. And then one of the main factors that we look at in our trades is the implied volatility. It's going to give us an idea of how options are going to move, whether it's in our favor or against our favor, and certain situations where we need to avoid trading options, let implied volatility settle down. This way, we're not putting ourselves at extra risk in our trade. So I'm going to show you guys real quick how you can find the implied volatility by yourself. So when you're on whatever your broker is, when you come to the options chain, it's going to be on this area where you find your expiration date, basically. You can add a separate implied volatility to the exact contract based off the strike price, but the one I look at and the one most of the traders look at in stock hours is going to be the one based off of the expiration date. So this reflects across all the contracts, whether it's calls, puts, in the money, out the money. The implied volatility on the overall expiration date for the contracts will affect every single one. So some examples of times where implied volatility is going to be abnormal is going to be earnings week, for example. So let me see if there's any stock with earnings this week. I can give you an example on. Cool. So Alibaba reports tomorrow morning. So their implied volatility should be a little bit higher than what's normal for that stock. So right now they're pricing in about a $5.50 move by the time earnings is over and done with, and this expiration hits. So when you're looking at implied volatility, this plus or minus, that's telling you what's priced in for the stock to be trading at by this expiration date. So since they're pricing in about a 5.6 $5.60 move by May 17th, they're expecting this stock to go up $5.6 or down $5.6 by the time that this hits. So with that being said, and knowing that there's earnings tomorrow morning, most of this move is expected to happen at that earnings release. So after the earnings release happens, and most of the move already happened, so maybe the stock goes up, $5, this implied volatility is going to drop down pretty significantly. So right now it's showing at 80%. In the first 30 minutes of the market, it might drop down to 50 or 60%, which is going to basically drop the value of all these contracts because they're pricing in that the stock isn't going to move nearly as much. So that's one thing about implied volatility that's going to be very important to notice, is that when it's very high, contracts are going to cost a lot more across the board, whether it's calls or puts, in the money, out of the money, it doesn't matter. If the implied volatility is very high, all these contracts are going to cost more than what's normal. So let me show you some examples. So if I go to NVIDIA, right now around where we're trading at, you have $1,500 to $1,700. When you go a little farther out, obviously it's going to be different, but that's where you want to base how contracts are trading at, is when you look at the money strike prices. So for example, if NVIDIA had earnings this week, this percentage might shoot up to 100% or maybe even more than that, and then these contracts might cost $3,000 at the money. So with that being said, they're not going to move dollar amount wise, they're not going to move double the amount so that you can catch the same percentage. It's still going to move what it regularly moves. So if at the money strike prices move 50 cents for a dollar gained on the stock, you're still going to gain that 50 cents, whether implied volatility is at 50% or 100%. So with that being said, if these contracts cost $3,000 and you're used to catching a 10% move with a $2 move in the stock, then you might only get a 5% move, or maybe even less than that, because these contracts just cost way more. So if you ever are trading before an earnings release, before maybe there's news, so if Apple is announcing that they're going to have an iPhone event, that might shoot up implied volatility leading up to the event. So if you catch whatever move that you're used to catching, you might not make as much in a percentage wise. You still will make the same dollar amount because it's still going to be, the same delta for the contracts. It's just that these contracts are going to cost way more. So delta is going to be a smaller percentage of the overall contract's price. If you ever are trading after an earnings release, so for example, if Nvidia reports Wednesday night or Wednesday after market close, on Thursday's open, I would recommend that you wait at least, 5 to 10 minutes at the very minimum for this implied volatility to settle down, because like I said, implied volatility is going to add premium across all contracts. So if implied volatility is dropping while you're in a trade, the trade could be moving in your favor, but you can still be losing money because the implied volatility premiums are getting taken away from every single contract. So there's going to be times where, the stock might be flat, but you can be losing money because of the extra factors such as implied volatility dropping during your trade, causing you to lose money. So most of the time when you're trading, implied volatility is not going to be something that's super important to really be looking at, because obviously most of the time the market is trading regularly. There's not always going to be huge news coming out for a specific stock. Stocks obviously only have earnings once a quarter, so every couple months, you're going to have to think about the implied volatility or how contracts are priced due to that. But for the most part, it's not really something that's too important. It's just the occasions where that there's news coming out, or that there's news that did come out already, or if there's earnings coming out, you have to be conscious of that. This way, you're not going to trade based off of how contracts moved in the past. You're going to be trading based off of what you're going to anticipate the other factors to factor into how your contracts are moving. So I'm going to show you an example of a stock right now that is very hot in the market. A lot of people are talking about it, and it's up a tremendous amount today. So if I go to, there's two different stocks I can look at. So first off, when I come to Nvidia, it's at 48%. Let me go to some other stocks that we're used to trading pretty much every day here at Stock Hours. So Tesla, another stock we trade very often, 50%. So we're still around that 50 mark. If I go to even SMCI, a more volatile stock, let's see what this implied volatility is trading at. So even here on SMCI, a more volatile stock overall, this is only at 70% right now. So when you come to stocks that have abnormally large moves in a single day or a single week, for example, you're going to get an implied volatility that stands out so much where it's almost impossible to avoid. It's something that you need to be looking at even when you're in the trade. So the example I'm going to go with is right now GameStop. You can see GameStop's implied volatility right here, 462%. So that's obviously way more than what's normal. So they're pricing in, by the time this expiration hits, a $12.50 move, which doesn't sound like a ton, but when you come to what the stock is actually trading at, $30, that's almost 50% of the stock. That's probably about 40% of the stock. So they're pricing in that this stock by Friday close is going to move up or down by 40%. So that's a huge move. So that's why these contracts, for example, are trading at a similar price as some of our other stocks that are in the $400, $500, $600 range, is because they're pricing in such a big move. So usually when a stock is trading at $30, these contracts are going to be very, very cheap. They're going to be usually under $1. As you can see, the at the money strike prices are at $600 right now. And the reason for that is because of this implied volatility. So if you were to trade something like this, GameStop, for example, you're going to have to monitor your trade and how implied volatility is moving while you're in the trade. If it's going up, that's good. That's just telling you there's extra premium getting added to the contracts while you're into the trade. That's even more reason to maybe hold a little bit longer. But now, if the stock is even going in your favor, but you see implied volatility is dropping, then you might want to get out sooner than later, because if your stock pulls back while implied volatility is also dropping, your stop loss can go from, your anticipated 10% to very easily way more than that, because you're losing so much extra value on your contracts. It's not just moving based off of how the stock is moving, it's moving based off of the outside factors, such as implied volatility. So I'm going to pull up one more example of one of these, ape stocks. 406% on AMC. They also, if you look, they made an 83% move in one single day. They're pricing in a $2 move by Friday's close. So it doesn't sound like a ton, but when you come to the stock's price, $5, $2 is a very significant portion of that. So if I come back to, one of our regular stocks that we trade, NVIDIA is pricing in a $36 move, which is way more than even what, GameStop is overall trading at. GameStop's at like $30. But this implied volatility is still at 48%. The reason for that, $36 on a $900 stock is way different than $36 on a $30 stock, or even $12 on a $36 stock, or a $30 stock, whatever. So that's something that you definitely want to be paying attention to, especially if implied volatility is way higher than what is normal. Now, on the flip side, if implied volatility is very low and you get, basically the same move that you're used to, you might get paid a lot more in a percentage wise, because these contracts are going to be cheaper than what is normal for the stock. So on the same coin that at one time it might be working against your favor, it can also work in your favor. So for example, if we on a stock have a tight consolidation for a week or 2 weeks, this implied volatility might drop, and the day we break that consolidation and make a big move, you can get paid a lot on a premium flip of just implied volatility going up. Obviously you'd be getting paid from the stock having the move out of the consolidation range, but also the option chain is going to reflect that in the implied volatility. So all these contracts are going to gain some value from that implied volatility spike. So that's something that, if you can get, that'll obviously be good. It'll help you a little bit extra, is catching that extra premium flip. But that's obviously not going to happen all the time. Stock's not always going to be in a tight consolidation for like a week or 2 weeks, to where you'll be able to catch that consistently. But if you are able to catch it, then that's definitely something that's going to pay you more than your average move. The only thing you need to be careful of is when the implied volatility starts high and then drops while you're in the trade. Whenever you see something like that, you want to get out as quickly as possible to not expose yourself to too much risk that is going to be hard to make back. So this is how I use implied volatility to trade options. If you guys know about this, leave it in the comments below and tell me if you've ever seen a situation where your contracts have moved either more in your favor, or you've experienced IV decay, so contracts not moving while the stock is moving in your favor while you're in a trade. If you've experienced that, leave a comment below and let me know kind of how it worked out for you. But if you guys like the video, make sure you leave a like below, and I'll see you guys soon. Peace.